So you're about to buy a home and you're wondering, how do I know which mortgage offer is the best? The one with the best interest rate, right? Well, in this video, I'm going to take you through how to analyze your financing terms to know which lender offer is the best to go with. And if you stick with me till the end, we'll talk about a bonus tip that you definitely don't want to miss. And we're going to get after it right now. If this is your first time to this channel and you want to know everything about financing a home purchase, then subscribe below, tap the bell for notifications so you can be the first one to know about updates to the mortgage financing world. My name is John Ritter with Ritter Mortgage Group, and we get calls and emails every day from people just like you looking for help on financing their upcoming move, and we absolutely love it. So whether you're moving in 9 days or 90 days, give us a call, shoot us a text, send us an email. All of that information is down in the description below so we can help you make a smooth move to your next home. Now, many times, first-time home buyers and even repeat buyers get too focused on the interest rate when making their decision on which mortgage lender to go with. However, the lowest interest rate doesn't always mean the best deal. Usually, the lowest interest rate comes with the highest closing costs. So when considering which option to go with, it's more than just interest rate. You need to consider the cost to get that interest rate. And again, typically, the lower the interest rate, the higher the closing cost. The higher the interest rate should mean the lower the closing cost. So this begs the question, why don't all banks have the same interest rate? Well, because when they set their rate, they have to factor in the cost of their overhead, their buildings, their employees, their salaries, their benefits. All of that cost has to be included for them to run their business. So when they figure out what their overhead margin is, then they're going to add on top of that their margin for profit. So depending on how much their expenses are and how much money they want to make, that's going to determine the interest rate that they will offer to you. And that's what we call in our industry the par rate. It's the lowest interest rate they can offer to make what they need without charging you any additional costs. Now, if you want to get a rate lower than that, you can, but now it's going to cost you some additional money, typically called discount points. You're going to pay some variation of points to get a discounted interest rate. And the lower the rate you want, the more in discount points you're going to pay. One discount point is 1% of the amount that you are borrowing. So hypothetically, if you're borrowing $300,000, then 1 point would be $3,000. A common misperception is that by paying a point in discount fee, you're going to also get a 1% discount on your interest rate. That is not so. It's not a 1-for-1 when you pay points. Typically, a 1% discount fee is going to get you about 1/4% discount on your interest rate. But it also works in reverse, meaning if you're willing to take a rate that's higher than the par rate, now the bank will give you some credits towards your closing costs because now they're going to be making more money than they need from the interest over the life of that loan, and they're now willing to give some of that back to you as a credit. So, did you know that getting the lowest interest rate may not be the right mortgage for you? One of the factors you need to consider is how long you plan to be in that house while you have this mortgage. Then you need to compare that to your break-even point. So meaning, if you pay points to get a lower rate, how much did the points cost and how much did it save you in your monthly payment? I looked at a scenario earlier this morning where the par rate, and here we are in November of 2023, the par rate was 7.375% for this client, and paying one discount point got that customer down to 6.99%. So if they had a $300,000 loan, it would have cost them $3,000 and they would have saved $78 per month. Now the break-even point in this case is 38 months. You take $3,000, divide it by the monthly savings of $78, and that is how long it takes to break even. So saving $78 a month for 38 months would equal $3,000. So the next question becomes, will you still be in this house 3 years and 2 months from now? Now, most likely yes, but I've had clients who moved to the area because of a job relocation and they know they're only going to be here for a short period of time. For example, we have 2 major military bases nearby, and military personnel are typically at a base for 3 years before they PCS to another base. Paying points to get a rate that's going to break even after 36 months is money down the drain. So you may say to yourself, well, I plan to keep this house for a long time, so it's okay to pay points. Not necessarily. The next question becomes, what do you think interest rates are going to do? If you think interest rates are going to come down, then there's a good chance you might refinance before your break-even point. If you think you have the opportunity to refinance before 38 months, you should not pay points. Now, for a while, the average mortgage lifespan was only 5 years before it was paid off. That means it could have been refinanced, the house could have been sold, or in some unfortunate cases, death or divorce. So the bottom line is, the further out your break-even point is for paying points, the more cautious you need to be to do it. So we need to examine this from the other side of the coin. That is, if you know you're going to be moving in a few short years, it might make more sense to take a higher rate and get some money towards your closing costs. So for example, in the same scenario where my customer could get the par rate of 7.375%, they could have opted for 7.625%, and they would have gotten a credit of $2,200 towards their closing costs. Now their payment would have gone up by $51 a month, but let's figure out the break even on that. $2,200 divided by $51 equals 43 months. So if they know they're going to move in 3 years or 36 months, they would be better off taking the higher rate, grabbing the credit from the bank at closing, because they know they're going to be out of that mortgage before the break-even period and beat the bank on that deal. Now let's bring this back to comparing loan options and figuring out where you're getting the best deal. First, you want to find a lender that has low overhead or low overhead margins. Some of these big banks have layers and layers of management, middle management, upper management, nice shiny glass buildings. Who do you think is paying for all of that? You are, through the interest rate that they give you that's been marked up to cover their overhead margin and then marked up again to create their profit margin. Now, how will you know which bank has low overhead margins? Well, by asking for a loan estimate and looking at 3 specific areas. Now let's jump over to the computer and see what I'm talking about. So the first thing you want to do is you want to look at the interest rate. That's the starting point for everything. We're looking at the interest rate. And while we're looking at the interest rate, I also want to point your attention to this red box on the screen here. And that basically is telling you whether or not the loan is locked or not. A lot of times, unfortunately, there's loan officers in this industry that will create a beautiful looking estimate. It's got a nice rate on it, it's got some nice costs on it, but it's not locked. And quite frankly, if it's not locked, it's not worth the paper that it's written on, because the next day they could call and say, oh, Mr. and Mrs. Borrower, I'm sorry, the market's moved, we can no longer get this rate for you. But you've already started in the process with them and you feel like you're kind of obligated, you're in motion, and now it's too late to back out, so you're stuck. So if it's not locked, it's not anything. You don't have anything. So we're looking at, is it locked? We're looking at the interest rate. Now the second thing that you want to take a look at is the cost, the total cost. This box up here in the top left-hand corner is your loan costs. These are the fees that are directly impacted by the bank. Quite frankly, everything else on your loan estimate, the bank has zero control over. They don't control the title fees. They don't control the taxes that the county and the state are going to charge. They do, in a theory, control your escrows, but your escrows are based on the property taxes for that property, and it's based on the homeowner's insurance for that property. So you pick the property you're buying, and you pick the homeowner's insurance that your company that you're going to use. So all they're doing is setting up the right number of months that they're going to need to put into your escrow so that they can pay those when they come due. So you have control over that. So everything else on the estimate, they have zero control over, except for this box on the top left. So the second area that you want to look at is what is the total of these charges? Now, banks are going to have different labels for different fees. You might see some banks, in this example that I created, they have an underwriting fee. Some banks have an administration fee. Some banks have a processing fee. Some banks are going to have a loan origination charge, or in this case, I put a discount fee of 2% for our illustration here. You want to add up all of those charges and see what the total dollar amount is for those charges. So the first thing is we're looking at the interest rate, we're looking at the charges, and then the third thing you want to look at is there's a box over here. There's a line item that says lender credits. So remember, in the example that I shared with you earlier, if my client took the little bit higher rate and they would have gotten $2,200 in lender credit, that would show up right here. So you're looking at interest rate, is it locked? You're looking at the total charges, and you're looking at the credits. The other thing that you can look at that is helpful to see is the monthly payment. And the secret with that is sometimes we see, particularly when it comes to a refinance, lenders will just show you, hey, here's your payment. And they don't conveniently show you your loan amount, because what they've done is they've padded your loan with a bunch of fees. So they say, oh, there's nothing out of pocket. This is how much money your payment's going to be. Everything looks good, but meanwhile, they stuffed $10,000 in fees into your loan, which is astronomical. But you won't see that on a purchase transaction because you can't do that. So purchase transaction, interest rate, is it locked? You're looking at these total fees, and you're looking at the credits. And the reason why you need to look at the whole picture is because, let's say you went into Bank A, and Bank A says, hey, our interest rate is 7%. You say, okay, great. Then you go over to Bank B. Bank B says, hey, our interest rate is 7%. Well, on the surface, they look the same. So how do you know which one is better? Well, if you go back to Bank A and you say, hey, how much does it cost to get that interest rate? And Bank A says, oh, that costs $5,000 to get that interest rate. And you go back to Bank B, and Bank B says, oh, it costs $10,000 to get that interest rate. Now you know who the better offer is, and that is revealed through what we call the APR. Now, when done correctly, the APR is going to tell you how much that interest rate is and the cost to get that interest rate. So the APR is not the interest rate that you pay back the loan, it's the cost to get that interest rate. So they're looking at the rate and they're looking at the cost, and it's going to be reflected in the APR. And you really want to see an APR that's as close to the interest rate as possible. Because the closer it is to the interest rate, that means there's less fees to get that rate. If you see a wide margin between what the rate is and what the APR is, there's a big spread there. That tells you there's a lot of fees being put into that loan for you to get that. So again, it's not all about the interest rate. It's your interest rate plus the cost to get that rate. If you would like a free courtesy second opinion on an offer that you have and whether or not it's the right opportunity for you, we would be happy to do that. Remember, selecting a lender that does not have a large overhead, so that they, any cost that they can save on their overhead is being shared to you in a lower interest rate. That's what you want to look for. That's what you want to get when you're looking to buy a house. Again, my name is John Ritter. I appreciate you watching. For more fun facts about homes and money, stay tuned to our upcoming video next week. Thanks for watching.